Welcome, everyone. My name is Paul Mehring. I'm co-president of Access Capital. Access Capital is one of the founders of Launch, along with Assurance, Becker, and Citrin Cooperman. And we are all very excited you could join us today. For those of you who haven't had the opportunity to attend one of our Launch conferences or are not familiar with Launch, I thought I'd give you a brief background. The four founders of Launch have a long, deep-rooted history dedicated to the success of staffing owners. In 2015, as part of our thought leadership approach in working with our clients, we decided to establish our own staffing conference to provide owners and senior executives an intimate setting that was invitation only, where we could offer meaningful education and content that we felt was integral to their growth and success. At Launch, our goal is to address the current challenges that our clients experience each day in running their businesses. The main component of our conference is a panel of staffing owners and executives of large successful organizations that we invite to share their stories and experiences, both positive and negative, as to how they achieved their success. As terrific as our content sessions are, it is the networking, collaboration, and sharing of ideas that transpires amongst all our guests over the 2 days that makes Launch such an outstanding event. Now, we've all missed so many in-person events the last 18 months, and Launch was certainly one of them for us. As we began to plan the return of Launch for 2021, we realized it was likely a bit too soon to have an in-person conference, and we didn't feel a virtual conference was going to allow us all to achieve the same results that makes Launch so successful. That said, we didn't want to go another year without providing staffing owners and executives valuable content from terrific speakers, which leads us to our main event. But we do look forward to seeing you at our in-person conference in 2022. The founders of Launch are honored to have Brian Beaulieu join us today. Brian has served as CEO and chief economist of ITR Economics since 1987, where he researches the use of business cycle analysis and economic forecasting as tools for improving profitability. Brian has shared his highly valued research results via presentations, workshops, and seminars in numerous countries to hundreds of thousands of businesses, owners, and executives for the last 39 years. Founded in 1948, ITR Economics is the oldest privately held, continuously operating economic research and consulting firm in the United States. With a long-term accuracy rating of nearly 95%, ITR Economics has forecasted major economic events such as the Great Recession of 2008 years in advance. If any of you have heard Brian or any member of his team at ITR speak, you know you're in for a real treat. Brian, thank you.
Thank you, Paul, and that was a very gracious introduction. Thank you very much. And I want to thank our sponsors for making this happen. Without them, this wouldn't be going on. And you folks have taken a lot of time out of a very busy day, I'm sure, to listen to this. So thank you to you also. You should have a chat button, chat feature on your screen down toward the bottom usually. If you have any questions that come up as we're going through the material, please just write them in there. We are going to leave some time at the end for some Q&A. And if one of our sponsors spots a question that they would like to have addressed right away for whatever reason, then Mike was going to interject that question and we'll get it answered right away. But if I do this well, a lot of your questions will be answered as we go through, but please still type them in as we go through. We're all about helping you plan and navigate this future, this changing future with some degree of assurance. And fortunately right now, that assurance is basically good news in that trends have begun to solidify. The leading indicators are working again as they're supposed to. You'll be seeing all of that. The employment environment is clearly changed, and we'll be talking about that. Government is different. There's a lot for us to go forward with. And the key is, don't just accept what I have to say here this afternoon. Mentally push back, make me prove the point. Because when you do that, and I manage to prove the point, because it isn't just all theory, it's logic, then you'll be confident. You'll make plans with assurance, and that'll put you that much ahead of your competitors who are still unsure about what this future is going to look like. Paul mentioned our long-term track record. I want to show you how we did coming out of COVID. That middle column, data forecast, I probably should have the year. That was March 20th of 2020 that we had to redo our GDP forecast because COVID had struck. In fact, virtually every forecast that we had pre-COVID had to be torn up and rewritten. These 8 headline items you see on the left-hand side, they're our standard headline. We don't change that column from one year to the next, one quarter to the next. It is what it is. And you can see we had data through either late 19 or early 2020. So all the durations are 9 months because that's as much of a view that we could give people given the changed world. And you can see our forecast accuracy, and folks, compared to a lot of others, those are good numbers. And the reason they're good numbers, and there's a reason I'm telling you, is it's our view. We saw COVID as a natural disaster, not as an economic breakdown, not as an economic disaster. It was a natural disaster. And with that paradigm, we were able to go into history and recent history, long-term history, and view what natural disasters meant to localized economies, to regional economies, and even national economies. And then we simply extrapolated that to a global scene and watched how the different governments were responding. And that enabled us to, we think, have a really good perspective on how we were going to come out of this. And those accuracy numbers tend to bear that out. One of the reasons we have so many supply chain distortions right now, however, is because the governments, including the US and mainly the US, viewed this as an economic issue. So they responded very quickly, very forcefully, to their credit. They didn't dither. They didn't do a lot of wringing of hands, but they responded in the way that they knew how, as if there was an economic problem. So they threw massive amounts of money at it. So we have a demand situation in this country primarily, but in other countries to a lesser extent, that was radically propelled forward by all sorts of liquidity, credit, all of which seemed like the perfectly rational thing to do. But the supply chain was caught way back here. The supply chain was struggling to keep up because it was still moribund by ports being closed in China and Vietnam. And now because of the brownouts, blackouts in Europe and Asia and other parts of the world, and because of the different variants of COVID that people are contending with. And now we have this kerfuffle of ships and at the ports, getting the containers cleared, getting the railroad yards cleared, getting the trucking terminals cleared, all of which will happen. But it's existing today because demand was just supercharged with no thought to the supply chain being able to possibly keep up. So it will get solved, except in one key area, labor. There's a labor shortage, not only in the United States, folks, it's worldwide. And we're not at all convinced that that's going to be solved in the next 10 years. 8 years anyways. We expect that this decade that we are in is going to be characterized by essentially full employment in the US. So for those of you who are in the business of finding people and providing them to the business environment, you're going to be exceedingly busy. And the really good ones at doing this, finding the talent and presenting this talent and having that talent stay with the right company, your outlook looks phenomenal as far as we are concerned. That's one of those changes that looks like it's going to stick. This is our forecast of GDP through 2024. The blue, dark blue, that's actual. You can see how fast the recovery has been since that second quarter low in 2020. That's the COVID low, that missing tooth look. 4 quarters of rapid ascent. Apparently the third quarter flash estimate came out today and it shows a slower rate of rise. And you can see by virtue of the green bars that that's what ITR was anticipating. We weren't going to be able to maintain that slope of ascent. We're going to get into some more normalized growth rates. We are at a record high. We have come back from the COVID low in record time by any standard. Second quarter GDP came in 0.9% ahead of the year ago level, and we've got GDP climbing out of here all the way through at least the end of 2024. So yeah, we've been supercharged with the demand, get that, but the underlying demand pull on all of our businesses is going to be there. We slowed down in the rate of rise. I'm going to show you leading indicators that speak to that flattening you see in GDP out there and later on in 22 and 23. That's pretty much written granite now. And we're waiting for signs of that reacceleration. We think GDP is going to rise beyond 2024, maybe as much as the first 3 quarters of 2025 before we start finding ourselves in a little bit of trouble. And I'll define that for you also. But one of the 2 premises I'm trying to get across to you is strong demand pull, because our economy, the global economy, is growing and people are going to remain in short supply. And I'm hoping that's getting your wheels turning in terms of, all right, what am I going to do with that? How am I going to make the most money I can out of that? Do I have enough time? Do I have enough energy? Do I have enough working capital? Do I have the right people working with me to really take advantage of these circumstances? Because that's what the name of the game is. Do better than your competitors at taking advantage of these circumstances. This is a rate of change comparison. I'm going to define rate of change better for you in a few moments, but these are 12 over 12 rates of change. You can see that denoted on the bottom right-hand corner. The 12-12 is simply taking annual average data. So the annual average number of people employed under temporary services agreements and comparing that total to where we were 1 year ago. So for temp services employment, we're above that black horizontal 0 line. We're up at 3.3%. That's scaled on the right. The overall economy, as depicted by US industrial production in this instance, is the blue line, 12-12 rate of change. So industrial activity is up 3.3% year over year. It's on a different scale on the left. And I have the scales slightly different, so you can most easily see what I'm trying to show you here. As long as our economy is growing, we're above that 0 line, we tend to do well in temp services and in full employment services. But we are not, excuse me, we are not recession proof. Whether in full employment or temp services, when that blue line went down in 2000 through 2002, we had that recession also. During the Great Recession, we had that downturn. We saw it to a lesser degree during the oil-driven recession of 2016, and we certainly all felt it during the COVID recession. You and I are going to prosper as long as the economy is prospering, but large swath of what we do is going to get hurt during the next recession. And I'll be showing you in greater detail when we think that's going to happen. But I'm trying to plant a seed with you right now, and that seed is this. All right, I felt some of that pain. Maybe not in COVID because of where you're positioned, but maybe you felt it in the Great Recession. You've been around long enough, you felt it in 2000, 2001. You know what I'm talking about. So if I'm telling you that there's another recession coming in 2026, the name of the game, the third salient point that should be in the back of your head is, what am I going to do about that? How am I going to handle that? Do I want to go through a recession? Probably not. So that leaves you with a couple of choices, right? You get out of the game before the recession happens, or you position your business in such a way that any macroeconomic recession has a minimal impact on you. Again, you're doing better than your competitors. Your cash flow is stronger. That puts you in a superior position on the other side of any recession. Let's talk about government for a few moments. I didn't bring along the charts to show you. So let me just speak to something, spending more. When I say that, I think people immediately flash to the fact that we have this new administration, this new Congress, and they say, oh yeah, that's what he's talking about. That's not what I'm talking about. At ITR Economics, we are political party agnostic. We do not care whether it's a Republican or a Democrat in the Oval Office. We do not care whether it's a Republican or a Democrat heading up the House or the Senate. Don't care. What we care about are the policies being put forward. And those policies really don't change a whole lot in terms of running a deficit. The reasons why change, what the emphasis of the deficit spending changes, who it benefits changes, but the reality of spending more doesn't change. This modern era of increasing the national debt started under Ronald Reagan in the early 1980s. And our national debt and the degree of deficit spending has been growing relentlessly ever since, except for 2 years under Bill Clinton. And he didn't mean to do it. It just happened under his watch, I think, more than anything else. Remember this date, because history is going to note this date someday. April 2009. It was in April 2009 that our debt as a percent of GDP, national debt, just the federal, not state and local, went above 80% of GDP. Fairly classic economics, and it's borne out by studies, including our own studies at ITR, say once you go beyond that tipping point, you've gone into a territory that proves detrimental for the economy. So if you wrap all of what I'm talking about together, and I could show you the numbers, but I'm not going to, is that we're living in a really sweet spot right now where all of this deficit spending hasn't really led to interest rate increases. This is the US government long-term bond yields. So for people who've been on the edge of their seats fearing interest rates going up because of all this deficit spending, because of all the money that's been created by the Federal Reserve, all the stimulus checks that's been let loose by Congress, they've been disappointed because inflation may be out there, but we're not seeing it in interest rates. And that's driving some people a little crazy. I can tell you why it drives them crazy, because they live in a world of instantaneous gratification. I can tell you why it isn't happening, and that's because the Federal Reserve, and they influence the short-term interest rates, and the bond market, which is much bigger than the Federal Reserve, and they control long-term interest rates. They're not concerned about the current level of inflation that you've been reading about. They know it's transient. They think it's transient anyways, and ITR, we agree with them. The interest rate yesterday closed at about 1.56%. So we're a little bit elevated from the 1.4. This is monthly data from 1990 forward. We are looking at some exceptionally low interest rates. This bond market, besides telling you and me that you don't need to worry about inflation for the next 18 months, because that's how far out into the future the bond market looks, is 18 months. They're saying, don't worry about it for the next 18 months. We're not worried about it. You shouldn't worry about it. The other thing that the bond market is telling us with these very low interest rates is they're also not concerned about the level of deficit spending at this time. The world still considers us the best world reserve currency there is. And as long as that continues, we can play this game. And they're telling you and me, don't worry about it for the next 18 months. And we believe them. But our long range forecast is that after 12 to 18 months from now, you're going to start seeing these interest rates go up. There is going to be more inflation out there in the future. There is going to be more and more impetus or desire on the part of government to raise our taxes. Now, no one knows if they're going to get a capital gains tax rate through, but we do think we know is that it won't be what candidate Biden suggested. It won't be that obscene. It's going to be at a fairly rational level. The economists, statisticians, finance people, we all knew. If you raise the capital gains rate beyond 28%, there's a negative return to the government, because investors aren't stupid. They know how not to pay the capital gains rate. You simply don't engage in that activity, and the government sees a decrease in revenue. Everybody knows that. So what candidate Biden was saying was just candidate bluff. Coming in at 28% would make the most sense, but we still have the Obama surcharge of 3.5% to contend with. And then there's what the states do on top of that. Making it retroactive, a capital gains tax rate increase retroactive is not cool. It's very rarely done. The last time it was done was under Bill Clinton, as a matter of fact. And it is beyond the pale in terms of allowing us to engage in rational planning. Will they do it? No one knows, folks. All I know is if you're in the M&A space anyways, and you're worrying about such things, it's all about how you structure the deal so that you're walking away with the most after-tax income. And in some cases, that means you wait until you improve your EBITDA and you grow your bottom line as this economy grows for the next 3 years, and you can cover the increase in a potential capital gains rate. I guess it's my own bias. Every analyst has a bias, right? My own bias is I refuse to be driven solely by one parameter, that being taxes. My analysis in my life and in studying history is people always find a way to legally circumvent a lot of these seeming issues. I think the takeaway from this is that now is the great time for you and me to take advantage of these attractive rates, leverage this future of ours, make some acquisitions. You know, I showed you GDP. We've got a good solid runway ahead of us. You don't have to worry about, is this a time when this business is about to come off the tracks? Or if you understand its markets, you understand the business, you know you've got a good runway ahead of you. Or make investments in your own businesses. Invest in efficiency so that your business can cope with the future inflation that's coming, with your own labor increases that are coming. We're entering into a period where, by the way, if your marketing programs are subpar, if you don't know what your competitive advantage is in the marketplace, you better take some of this money and find out what your competitive advantage truly is. And you better learn how to market yourself very, very well, because during a period of inflation, you need to differentiate yourself more and more to justify your pricing. And even if you're not making any acquisitions, right? There's all sorts of ways we can engage in organic growth. Most of them take money, and I'm telling you, this is a great time to be engaging in getting hold of that money and investing in yourselves. Please. All right, shifting gears here, talking about some of our global partners. First thing I want to say is, because I mainly talk to US businesses, we tend to assume that the rest of the world responded to COVID the way we did, and that's a fallacy. The US was relatively unique in terms of how much money it threw at the problem in terms of free money. You don't have to pay us back, PPP, stimulus checks. That happened to a lesser degree up in Canada, messed up their housing market, as well as creating the asset price bubble we have here in the United States for housing and for stocks. But most of the time, it was through loan programs that eventually have to be paid back. So you didn't see that same bubble mania develop out of this. So the supply distortions primarily driven by the US. The supply problems have become global. That's one of my favorite charts. And because I haven't done this platform before, I want to make sure that you start. The United States, we're the #1 economy on the planet with 24.6% of the world's GDP. China's #2 at 17.5%. Japan used to be #2, now they're #3. Germany's been #4 for the longest time. Okay. In India, you can see for all the talk about India, they're at 3.1%. And eventually you get to Russia, they're down they're still there, category of 1.7%. You get into some pretty small slices pretty quickly. By the way, I'm also demonstrating the 80-20 rule. 19.1% of the rest of the world, because essentially 81% of the world I have identified for you, and the rest of them are very, very small. The Pareto principle, it's amazing how often it shows up. Your takeaway from this, I'm trying to save you some time, really. Don't bother reading the articles that tell you that the world is changing, that China is going to take over the United States. It isn't. Not for the next 100 years will China take over the United States. We will be the world's largest economy for those 100 years for very simple reasons. 3 reasons. 1, demographics. Our demographics are positive. China's a negative. Germany's a negative. Japan's a negative. Brits are negative. France. Actually, France is a lot more like us, but they have other problems. India has strong population growth, but they fail on a couple of other measures. So there's demographics. China loses. They're already losing people. Oh my gosh, their labor participation rate is falling and their demographics are negative at the same time. You also have to look at natural resources. And while China is geographically 3% bigger than the United States, they suffer from a relative paucity of natural resources. We've been mightily blessed with natural resources here in the US. Yep, China's locked up lithium by buying the mines in Canada and elsewhere around the world, and they certainly are colonizing Africa because they need the natural resources because they don't have their own. We have them. And in a period of inflation, history is very clear. Whoever controls the natural resources, whoever owns the natural resources, whoever invests in the natural resources wins. All right, and the third factor that says we're always going to be number one, rule of law. Without a real rule of law, and that means independent judiciary, intellectual property rights, personal property rights, those are together, and bankruptcy laws that really work. Without that, you will not sustain, you will not be sustained. China's best days are behind it, folks. Our best days are still ahead of us for the three reasons that I just told you. So stop reading those articles, stop worrying about it, and start realizing you are looking at a future. You and your businesses, your families are looking at a future in the strongest economy, the biggest economy, and the one that will be the strongest and the biggest for the next 100 years. This whole world of ours, and I'll show you the US dashboard in a few minutes, is looking at leading indicator trends telling us that slowing growth is probable for 2022. You see that under comments, and the ... is because as each month goes by, and here we are in late October, it's also now telling us that we're looking at slowing growth for the world economy beyond just 2022, but at least into 1Q 2023. The trends are in decline, they're rate of change trends, but the world is not going to go into decline. Look at the title, Decelerating Rise. That's going to allow supply chains for material goods that are largely stretched, broken, twisted right now to heal. The demand curve, which has been pushed so out front, is actually going to come back to a more normalized level. And that gives the demand curve, supply side of it, rather, a time to get caught up because the profit motive hasn't gone away. And, you know, supply will get caught up, except in the area of people. And that's where, if you're in the people business, it's a different paradigm. Let's look at some US trends for 2022 through 2024. We're going to use a lot of rate of change, so I briefly want to walk you through that. For your own business, you can do this, and then we certainly encourage you to do it. This is a very powerful management tool, as you're going to see. You just load in your raw data into Excel. This could be revenues, could be profits, could be contracts processed. It could be any measure that's important to you. And we aggregate that, and we suggest you do that into 3-month moving total. So we'll add June, July, and August to come up with that 18.3. And then we'll see how that 3 months compares to 1 year earlier. So we're going to compare 18.3 million to 14.2 million, or 18.3 thousand to 14.2 thousand. And I don't know why I lost my clicker here. There we go. Back it up, Brian. And that shows that we're up 24.3% year over year. You'll notice that the numbers were even higher a couple of months ago because the bottom of the recession was 2Q20. So now we're starting to compare strength against improving dynamics, strength against more relative strength anyways. So seeing that 312 go down is not unusual at all, and it's not worrisome. Then we run a 12-month moving total, 12 consecutive months worth of data. Then we'll compare that same 12-month period, but 1 year ago, and we derive that 12 over 12 rate of change. And most rates of change, 12-12, should be rising. Yours should be rising. Not at all surprising to see if your 312 is crested, but you should be looking at some nice year-over-year gains occurring as we start comparing to even post-COVID levels of activity. If you see that 312 going down, it simply means we're heading toward normalized growth. And it's the rate of change that is defining that middle trend column for us here. This is our dashboard for US, one of them, and it has 12 on it. 11 out of the 12 are showing decline, which means decelerating rise is probable in the US for 2022 and because of where we are. And at the top of this leaderboard, they lead by 4 months. We're increasingly looking at probably at least 1Q 2023 also. Slowing growth. It means there's time for you to get your resources in alignment if it's been helter skelter. It means it's time to figure out what sort of roll-ups you might want to do geographically or institutionally. This is a breathing spell before it reaccelerates. One of the reasons we think it's just a soft landing in the economy, that there will be a reacceleration, is look at disposable personal income. This is after-tax income, eh? You can see when the stimulus checks hit, people got this massive influx of money. This is one of the reasons why we never thought the economy was broken. When people have money, the economy isn't broken. In fact, they had more money than they knew what to do with, which is why we saw, well, what now is normalized, normal is in quotes there, to about $500 billion in excess savings out there. That's latent consumer buying. At 15.6 inflation adjusted trillion dollars, we're looking at income levels higher than where we were pre-COVID. That was full employment back then. That was retail sales doing well. That was the world humming along, and here we are humming along. As a bellwether for the overall US economy, this is our outlook for housing starts, single unit housing starts. And you can see by virtue of those blue diamonds, we have rise going on throughout 2024. That's driven by demographics. The millennials are buying. They're buying with as much vigor as you would have expected boomers and Gen Xers to buy. They're just late launching for various and sundry reasons, but they have launched. They are buying in suburbia, not just urban areas. They're buying cars. Low interest rates, as I mentioned, for at least the next 18 months, but we don't see any rise in mortgage rates becoming deleterious to this market until we're into later 24, 25. So that continues to drive this market higher, and low inventories continue to be the rule out there. Most people, when they're looking at this chart, they can't help but be drawn to that huge cataclysmic decline that occurred there in 2006. And sometime after this, you may pause if you haven't already and say, well, all right, ITR is saying recession 2026, rising interest rates. Are we heading toward another one of those cataclysmic declines? And the answer is no, we're not. When we look at the circumstances that led to 2006, 7 and that decline, they're nothing like what we are looking at today, except for pricing reflecting asset bubble conditions. But the consumer is using a lot more cash today on homes than they were using back then. The consumer's balance sheet is certainly much stronger today than it was 2005, 6, 7, and 8. Default rates are low. We're likely to see prices reset mid-decade before they start to rise again because of that overall input from or force called inflation. What I'm trying to get at is this: if you've been looking at buying a piece of property, a home, let's say, and you're thinking, well, these prices are nuts. I think I'll wait till the prices to come down. What I'm trying to tell you is the prices aren't going to come down until 2026. So essentially, by waiting, what you're saying is, I'm going to let some other family live in that home, and who knows what their dog is going to be doing in that home for the next 3-4 years. And I'm also going to buy that home, unless I'm paying cash, with interest rates higher than where they are today. And based on ITR's outlook, prices aren't going to come all the way back down to where they are today because we've got a lot more rise ahead of us. So from our perspective, an economic perspective, why are you waiting? You might as well just, if you found a home, it's in the right location, just do it. I don't see any upside to waiting, folks. I'm heading up for whatever it's worth. Let's talk about people and wages. We have a labor shortage in the United States. We also have a labor shortage worldwide. It blew my little mind when we saw, and this was last month sometime, that China also has a labor shortage. And we knew labor costs were going up. We knew people didn't want to continuously move to the urban areas along the coast. but to have an actual labor shortage, even internal, to see labor participation rates go down, see that they're losing about 30 million people from the workforce every 15 years is just all kind of mind-blowing. So it's not like we could open up the floodgates of people and expect the whole world to satisfy our short-term or our longer-term needs here. And this is the 12-month moving average. Take manufacturing, for instance, 698.9 thousand job openings on an annual average basis. The latest monthly data is over 800,000 jobs that are open. Wholesale trade, more than 250,000 jobs. Transportation. We're not all of a sudden going to find these people. What we're going to find is that people are going to become worth everything that they're asking. There's a fundamental shift that's happened because of COVID. Pre-COVID, employers, we had the power. Post-COVID, employees seem to have the power. Suppliers right now have the power. Employees have the power. And certainly suppliers of people probably win twice, being suppliers and in the people market. If you're good at bringing people into industry, whatever that industry may be, man, you just wrote yourself a golden contract as far as we are concerned going forward. And if you are that good, make sure your marketing is that good at the same time. Looking at the cost of people, this is for professional and business service workers. This is a little bit complicated. On the lower portion, you have the data. And that's scaled on the right underneath MMA, which stands for monthly moving average. So that black line is a 3-month moving average, and the green line is a 12-month moving average to smooth out any seasonal variations. And you can see both are climbing. Now on the upper portion, you have the rates of change. They're scaled on the left underneath ROC. And like a lot of other rate of change charts you can look at, when it comes to these earnings, it never goes below zero. The 312 did back there at the end of the Great Recession. But the worst this ever gets to is a little bit better than the CPI rate of inflation. This is relentless price increase, relentless earnings increase. This is why the politicians are nonsensical when they say real earnings aren't going up, because if I adjusted this for inflation, which I mentally did when I saw the rate of change, real wages are going up. And people need to wrap their heads around that. And unfortunately, I think, in terms of inflation, unfortunately, employees fully understand this now. It is part of their psyche. They know they can get more, and that's one of the reasons why their job hopping is to accelerate that getting more. This is professional and business services employment. Look at where I drew a circle down there in the data. You know, the economy I showed you, GDP is all the way back, but non-employment for professional and business services. And you can see in the last 2 recessions, yeah, it took a long time to recover. I get that because the economy took a long time to recover, but this is not a normal recession. This has not been a normal recovery. This data trend should be back up to pre-COVID levels. The demand is there. And yet we're running above year-ago levels, 5.7%, as evidenced by the 312 above year-ago levels, 1.2 on an annual basis. But this is part of what some of us were talking about pre-webinar. In the college graduate space, not in the 65 and older space, we're seeing a reluctance to engage in labor. The labor participation rate in the educated level, professional and business services apparently, remains quite muted. They could be going back to work. They're choosing not to. And it could very well be because kids are expensive to place in daycare, or they decided, you know, life isn't worth us both being out of the house. So one parent is staying home with the child. And I think it's the employers who can accommodate that, who can recognize that and offer solace, comfort, or help along those lines. We'll have a winning card to play going forward. But in the meantime, between the participation rate being low and people still somewhat afraid of COVID, we've got a problem. This is temporary services. It looks exactly the same, right? As I gave you a circle in both. It's the order of magnitude that's different. This is 20.7 million workers. When you talk about temporary services employment, we're talking on an annual basis, 2.7 million, but this looks exactly the same. It should have bounced back more than this by now. It's got to be a participation rate, but in temporary workers, I think it's another dynamic. They're not interested in proving themselves to temporary services. And that's part of a trend. The brown line here is the data trend, 12-month moving average for total private employment in the United States. Temp services, 12-month moving average is that 2.7. You just saw that. And then that gray is the average of temp to total. And you can see that average has been sliding downward since about late 2015. And I think right now with tight labor conditions, I think you can build a pretty good argument that, and I've heard some of people in your space say this to me, so it's not my necessarily novel thinking, I've just thought through the logic. People are saying, no thanks on the temp to full-time. Get me full-time right off the bat. Give me the benefits, get me lodged where I want to be lodged, and let's be done with it. And if that's true, I think we're going to see mitigated ascent out of that 2.2% percentage, and placing full-time is going to be an easier chore. One of the things that we look at is quit levels. And for all of you in light industry, start off at the bottom. That purple is for non-durable goods manufacturing. The brown or orange, yellow, whatever that color is for durable goods manufacturing. And that's ultimately going to be driving transportation, et cetera. And those quit rate levels are elevated. The 205, for instance, in durable goods manufacturing, that says in the last month, because this is monthly data, 205,000 people quit their jobs. Probably because they're looking for a better one and they got offered a better one. And you can see as you look from right to left, it's a very high number, both for non-durable and durable. They'll pop up to the top because I spend more time in my life in that industrial sector. But look at professional and business services, 807,000 of them quit their jobs. This data would be through August, so in August. Wow. They really are just taking either the summer off or they're moving to another job. Maybe they're going to take some time off and then move to another job. I also layered in healthcare here because I have a daughter who's a nurse, so I'm always interested in that. And the healthcare sector lost 600,000 people in August, which is mind-blowing at a time when we need them. In most instances, by the way, where they're telling you that there aren't enough beds in hospitals for the COVID cases, it's been my experience, there aren't enough nurses. It's not so much the beds, it's usually a shortage of nurses. Here's something, I brought this along to you because I want you to see that the type of labor you deal with can alter how you perform. You're looking at the 12-12 rate of change for employment. Healthcare employment is the brown, and professional and business services, and I also could have layered in there if I want to make it more complicated, light industry. Light industry is going to move along with the blue. And I showed you that where the recession at the turn of the century was, and I showed you where the gray, I'm showing you where the Great Recession downturn occurred, and obviously even healthcare experienced the COVID recession. But one of the ways to mitigate the pain of a future recession out there in 2026 would be to maybe change the mix a little bit. If you're not involved in healthcare employment, given that has a history of being recession proof, maybe you want to tilt or lean into that market, or maybe you want to find some other markets by doing this type of analysis that are going to be more immune to a downturn. The legal profession tends to be immune to recessions. I mean, you can go in different directions to mitigate the downside economic forces. That's what I'm trying to get across to you. There are always opportunities out there. We have leading indicators for employment. This is to overall private sector employment. This is an ITR leading indicators proprietary to our firm, has a 10-month lead to employment. So all this is telling us is that the dynamic, ravenous rabbit pull for people is going to slow down. It's not going to go away. It's just going to be less rabid the deeper we go into 2022 and into early 2023. So it's going to be there. It's just not going to be as, oh my gosh, this is a crazy world. The immediacy may seem to become mitigated. Some of this is going to depend on where you live, right? Where you see dark green, those are the states that are seeing real population growth, the best population growth, at least between 2016 and 2020. Where you see the red, those are states that are losing people. And they're losing primarily young people, by the way. So in Illinois, are you going to buy a building in Illinois, wherever that building may be, when there's going to be less people to buy that building from you in the future? Or in New York or West Virginia? West Virginia, by the way, is our version of China. Mississippi, Louisiana, Wyoming, Alaska, Hawaii, the same deal, and other states in the Northeast. And even the pale yellow, Pennsylvania, Kansas, New Jersey, 0.1, there's nothing going on there. Wisconsin, I don't know if any of you listening in are from Wisconsin, but if you are, with 1.0, doesn't sound like much, but it's a whole lot better than 0.0. My advice for people in Wisconsin is you're going to want to build a wall between you and Illinois. And you want Illinois to pay for that wall also, just to stop them from going up there, because they're coming up, not because they're young, but because they are retiring up there and they're just going to be demanding more and more. The other fascinating part about this slide to me is the West Coast is no longer where it's at. The West Coast has moved east. The new West Coast is Idaho, Nevada, Utah, Arizona, Colorado, and Texas. And the southeast part of the United States is where it's at. You want to know where you're going to see the most demand for labor? You're going to see where the most growth, and economically speaking, you go to the dark green states. That's the future. Can't draw you an easier map than that. And it's true, by the way, for the world as a whole. I've spoken a couple of times about 2026, and I just wanted to show it to you using this chart. I call it a map, really, of industrial activity. We're growing, and that first peak you see out there is in late 2025. And then you see this dip into 2026. It's going to be unpleasant. It's not a light one. We're going to recover, new record highs, and then we're going to have that falling off as we go into the 2030s. And for those of you who know ITR Economics well anyways, you know that we've been talking about the 2030s being a difficult decade for, well, since 2016 anyways, we've been talking about it being a difficult decade. Thank you, whoever just muted your phone. I appreciate that. This is the beginning of what's going to be an arduous period for not only the US economy, but the global economy. But take heart. And that's why I brought along this chart, not because you're a specialist in the art of people, but I want to show you how we compare with the long-term future. This buttresses what I was saying about the US being the #1 economy for a very long time to come. Come 2030, look how our population percentage-wise is expected to bear out. 20% of us will be 65 plus, and you can read the other numbers for yourself. Now, focus on where I have boxed them in. One of the worst economies, demographically speaking, is China. Look at the disparity between age groups. They don't have enough young people there to take care of the old people. Immediately to the left is Mexico, and Mexico has even more young people. More power to them. India has plentiful of young people, except they're messed up because they don't have the rule of law, which is primarily Mexico's problem also. After Japan, look at China. It's a severe inverted pyramid there, much worse than we are going to have to contend with. And I've isolated the others for you. Where you see that inverted pyramid in red, you can assume there's going to be significant problems and even more pressure for where are we getting the money to maintain social order, social services. In the US, come 2036, the majority of us baby boomers are dead by 2036, right? So a lot of our problems get ameliorated by the passing of this generation. And the more young kids we have, and we have them right now aplenty, the better off we are going to be. We are at that time where I am supposed to be taking questions. Before we do that, let me just, one more point, if I may, and that is this. The stock market is going to be worrisome. We think it can be anyways over the next 4 months. You should expect a lot of beta volatility in the stock market because it's its own asset price bubble, complements of our government and the Federal Reserve. If you get that volatility, if you see your own statements aren't exactly as rosy as you would like them to be, I just want you to understand that we've taken that into consideration when we've laid out all these forecasts that we just went through. We get that. We anticipated it. It's not going to bring the house of cards down. That's much further out in the future. So this rising trend for 22, 23, 24, 25, even with some volatility in the stock market is going to be there. We expect the volatility in the market. So I'm going to open this up for questions. I think the first way I'm going to do that is by, if I can figure out how to stop sharing. And you're welcome to take yourselves or put yourselves on camera if you want. And I'm also going to look in the chat box for questions. I see one question so far. Vincent's asking, if possible, could you elaborate on staffing issues and where you see wage inflation and labor participation? Well, I'm not sure I can elaborate more on the staffing issues other than it is a function of labor participation and expectations. One of the things that we're counseling our clients is, because remember that it's primarily baby boomers and Gen Xers that are in power right now. And a lot of them don't understand the dynamic of what's changed. The millennials and the Gen Zs below them, they're not exactly wired the same way we are. They want to be well compensated. Not, and for people like me, when I was growing up or in the early days in business, or 5 years ago in business, it wasn't paying them the minimum I had to keep them. I have to pay them enough now that they're really happy. They want to be here. You have to have a culture today that people really feel engaged. They feel like they have access. They know they have access to power, but they also know that the core values of this company align with their own personal core values, and they want to be part of something larger than themselves. They want to know, and most entrepreneurs that I know are very generous, okay? But they tend to keep it under a bushel because we tend to be humble, really, and it's not like we brag. But if you want to engage the young and the brightest and the best, you better learn how to be less modest. You better be willing to show them, look, yeah, we make some money, you're right. But look, all we're doing for the community over here. Look at all the money we're giving over here. You want to work for me just because you want to make the world a better place. Not only in my instance at ITR, because we want to make capitalism more efficient, but we want to make the world of people a better place. And our employees dig that. They love that we're giving to food pantries, that we're helping at Christmas time, that we're planting potatoes and we're giving to organizations around the world. Because they know they're not just going to work for themselves, but they're going to work for all these other people. That wasn't the case way back, or several years ago for that matter, at least not for many companies. You also have to give more time off than you're used to. A company today that isn't generous with their PTO, personal time off, doesn't have a candle in terms of attracting or retaining people. And maintaining a work-life balance is something that I don't struggle with, but I still hear a lot of other firms struggling with. These kids today, these young people, they want so much time off to be with their family, to go see their kids play soccer, or to take Johnny to the doctors. I never took Johnny to the doctors. Oh, you know what? That ship has sailed. This is the new paradigm. If you have staffing issues as a company, it's because you're not offering the right culture at the right pay. And if I'm running a staffing agency, I want to seek out those companies that are digging this, that they understand the culture, they understand the pay, they understand what these kids want, kids being the millennials and the Gen Zs. And that's what they're offering. That's how you're going to build a long-term clientele that's really going to do great things for you. Wage inflation is going to be relentless, and it's going to be escalating along with the rate of inflation. And I didn't get into those charts because I went off on another tangent with y'all, but the rate of inflation right now is going to be coming down as you measure it by the CPI. But as we look out post 2023, you are going to see inflation rates that will be driving taxes probably higher, and certainly driving interest rates higher and higher and higher, the likes of which you haven't seen unless you can remember the first half of the 1980s. And if you can't remember the first half of the 1980s, and I'm confident in telling you, you haven't experienced, you haven't seen what lies ahead in terms of inflation and interest rates in the second half of this decade. That's why you got to make your move today. This is why you have to propel yourself to take advantage of these conditions while they exist and position yourself for that future. Labor participation, I don't know where that's going to go. I think government would have to become less nice, less generous with unemployment benefits.
Yes.
Okay. Another question. Did you review the trends of temp employment as a percent of full-time employment hiring? Yes, I did. It's 2.2%, and it is going down. Is it going down due to the current labor shortage? No, it's been going down since late 2015. Scott. So I don't think it's just because of the current labor shortage. What I was trying to get at is the current labor shortage may exacerbate that trend. That's the only question in my mind. But seeing that trend continue, pretty confident it's going to remain abnormally low compared to the last, say, 20 years as opposed to the last 6 years. Mike, great job, Brian. We all needed a good dose of optimism you shared. Thanks, Mike. And I shouldn't do this because you gave me a compliment, but I'm not trying to give you optimism. I'm trying to give you realism. My job is to show you, to the best of our ability, what will be, so you can pull the right levers at the right time, because I am interested in your personal well-being. I'm sorry for that ringing going on. This isn't optimism. This is reality. I wonder if I can turn that off. Reject. How's that? It just rejected my brother in favor of you folks. All right, I don't see any more questions coming in, Paul, so maybe we call it a day. What do you think?
Yeah, last call for questions. Either submit through the chat room, or I believe you can even unmute yourself if you'd like to speak to Brian directly with your question.
Yeah, that'd be great.
So feel free. Brian, this is incredibly powerful stuff. Can't thank you enough. For everyone, here we go. We do have a question.
Do I see wage growth increasing over 20%? I assume 20% per annum. And the answer to that would be only in very selective areas like keynote speakers. You may see it happening. I'm kidding. No, I don't see it increasing to over 20%, except for very, very specialized scientific areas. Other than that, no, I don't really see it sustaining over 20%. All right, Paul, you were saying?
What I was saying is powerful stuff, a lot of great content for everyone. I know this is a lot of information to absorb. It is for me. Each founder will post this presentation on their respective website. So feel free to view it again. And thanks, Brian. Terrific, as always.
My pleasure, Paul, and kudos to you and the other founders for making this happen. This is, it's a great thing that you're doing. I'm just glad to be part of it.
And thank you everyone for participating. We appreciate it. We'll see you in launch 2022.